Hi, I'm Chris Wooten, and this is Clear Direction for Retirement, a short, informative video from Wooten Financial Group covering what you need to know to set clear direction for a long and happy retirement. This is a third video of a 5-part series on the 5 most critical areas for retirement planning. In our last video, we covered the importance of retirement tax planning. Today, we will be covering investment planning. You know, I speak frequently about the fact that every year thousands of people retire or attempt to retire without seeking professional advice or having a well-developed game plan. Regardless of your age, we believe planning for retirement should include coordinating the 5 critical areas you'll face in reaching your goals in the next phase of your life. We refer to these as the 5 puzzle pieces of retirement. Like a puzzle, each piece must be coordinated with the others to get a complete picture. In your case, your complete picture is your financial plan, and that plan should drive the financial decisions you make as you move toward and ultimately into retirement. That plan should then be reviewed and updated frequently to stay on track. So let's take a moment and tackle the third piece of the puzzle, investment planning. Now, as I mentioned in our previous videos, evaluating your income and tax retirement goals is part of the key for investing properly. Unfortunately, most people walking into a financial office are simply being sold financial products instead of doing well-rounded financial planning. Whether you're working toward retirement or you're already there, proper management of your investment assets is crucial to sustaining your retirement income and keeping up with inflation or simply leaving a legacy. But this part of your financial plan must be coordinated with the other pieces of your financial puzzle to keep you from making some really huge mistakes. Furthermore, if you're still working, managing your 401k or other investment accounts until retirement is even more important because you're trying to meet savings goals, and most corporate plans don't offer true professional fiduciary investment advice. We have another video about 401ks I would encourage you to check out to that regard. Outside of managing the tax implications of your investment accounts, some of the biggest problems we see are that people don't truly know how much money they should save, how much money they really need to have in the market, nor how much risk they should be taking to meet their personal rate of return needs. Now, most financial firms would very happily invest all of your life savings in the market after a simple risk profile questionnaire. However, while sometimes this may be appropriate, the investment plan should always be coordinated with the rest of the planning areas to meet goals as closely as possible. Said a different way, your financial plan as a whole should drive how you invest. Outside of getting with a professional to figure out holistically how much you should be saving, there's a couple of important things to think about when investing toward and into retirement. The first is, what type of investment philosophy do you want to employ? That is to say, how do you want to manage investment market risk and volatility? The most common method we see utilized with folks coming in to see us is buying and holding some fixed percentage of diversified stocks and bonds over time, and then praying for the best in a major bear market correction event. Think about the 50% correction of 2008. What's your strategy for dealing with this type of event? Do you have one? We refer to this as a static risk management style, as it simply implies very little change in its attempt to manage risk. Or perhaps you would like your investment philosophy to lean more towards dynamically managing your risk. This is done through a more active investment management approach, an approach that's willing to change asset classes and sectors within the stock and bond markets when needed, and even exit markets when they get too turbulent. We tend to lean towards this investment philosophy. The second thing to consider is this. To the extent you can do so, don't put all of your eggs in the investment basket. Diversify risk away from the stock and individual bond markets so your income is not so dependent on market performance. I know not everyone can do this, but it's well worth the time evaluating if it's in your best interest to do so. I hope these brief insights on investment planning have been helpful. In our next video, we'll cover the 4th puzzle piece, insurance planning. Check out our next video in this series or our other informative retirement planning videos, and be sure to check out our website at wootenfinancial.com for lots of other great resources. And contact us if we can help you with finding clear direction for retirement.